So in the example that we have in our chart here, we have a nice candlestick chart with a big breakout at the end. But what's important is we have an established area of support indicated by the blue line. So let's imagine that this is not our first time visiting this blue line. We bounced up, we come back down, hit the level, hit it 1, 2, 3 more times, and we say to ourselves, look, we've established this area of support. We know that we've got a large order, or at least a lot of buying interest right at that level, and because it has acted as support so many times, I'm going to project that it's going to continue to act as an important support level in the future. So what you can do is employ a basic trading strategy called bottom fishing, or sometimes just called a bottom fish against a support level. So bottom fishing requires that you place bids or buy a stock or commodity right around an area of support, acting in good faith and hoping that that area of support is going to hold because it's done so many times before. It's an established level. Now, this strategy requires an exit strategy as well. So you're either going to wait until you hit a resistance or see if you break out of resistance. And in the case of this example, we can see that we ground our support many times before eventually just breaking a resistance, resulting in a very nice profit for whoever managed to get into this wonderful trade. So why does it work? First of all, the order book's on your side. You can look at this chart and say, I've got a large group of people. For example, $9.33. We know there's this monster crowd there. They want to buy. The price is not going to move lower because they will not allow it. They will buy up everything that they get. So if I can get ahead of them and buy, say, at $9.34 and wait for that demand to result in price increases, I will stand to profit from that. It's also great because it has limited risk. If we're using the $9.33 example, you can buy $9.33 and immediately sell if you hit $9.32 because you know that that wall has moved, the support is no longer there, and you can exit for a loss of 1 cent per share. These trades are absolutely fantastic for that and being able to really limit your risk while really opening up for a lot of potential upside. Also, it works because you're betting on exhausted sellers. If you have so much selling demand, if you're repetitively hitting that bid wall and the price does not move below $9.33, eventually you're going to run out of people who are selling, assuming that support stays there. And with a lack of supply, demand will increase and push the price up. So, basic trading strategy, watch for that established support level, set your stop losses right on the other side of that support, and wait for that demand to move that price up. So another trading strategy you can use is breakout trading. Now this is pretty much the opposite of our bottom fish. On the example you see here, the price is slowly moving up till eventually it hits $18.90 and we just start chipping away. There's a big group of people here who want to sell at $18.90. They refuse to sell for any less and they will not move. So everyone who's buying has to buy all of the shares at $18.90 before it can move. And they sit there and they chip away at it hour after hour after hour. Eventually, the sellers are gone. There's no one left selling at $18.90, but that demand stays there, that wall comes down, and the price skyrockets. So this works because there's buying after a big rate breakout resistance. You've used up all of the supply, but demand is still strong. So the few sellers who are there in the order book are stretched out way beyond $18.90, and anyone who's coming in needs to contend with a price above $18.90 if they want to sell inside their little tornado of volatility. The price tends to move very quickly. This trading strategy requires you to be able to identify these areas of resistance. It requires quick thinking and actions when these walls do come down. It's very volatile, but it can be incredibly profitable. And there are some people who only trade breakouts. They do so very consistently and very effectively. So the question is, why does it work? If you broke in $18.90, you bought all of the shares that are there, there's no one left on the ask to sell. So the order book must populate after the fact, and it's going to do so much higher than $18.90 because the sellers recognize that there's a demand, so they're going to try and get as much profit as possible. When the wall comes down, that big barrage of people on the other side stampede across the line and buy up everything that they can. There's a lot of enthusiasm. People are excited. They want the price to move. It's fun to watch. And it creates this positive feedback loop where you're looking at a stock or you're maybe in a chat room and people are saying, look, Tesla's breaking out, price is moving fast, and it might just keep going and you don't know how long it's going to go. So there is an enthusiastic feedback loop that gets you excited, that gets other people excited, and it creates this almost unstoppable train of profit. And breakout trading can be a lot of fun. There's a lot more risk than bottom fishing. But if you are quick and you recognize the signals and recognize the reversals, using breaks on resistance can be very, very effective for your own trading. So that's our introduction to support and resistance. And by now you should really understand that support and resistance represents range-bound trading action. You've got a line of resistance, you have a line of support, and you have really no idea what's going to happen inside that area, but you can use those clearly defined levels to set up some basic trading strategies. You should also understand how these are created by supply and demand and by the groups on the bid and the ask, and how the entirety of market psychology and individual traders relying on these levels tends to create these levels themselves. It's a self-fulfilling prophecy. The more often you see a support level coming into effect, the more likely you are to use that level for your own trading, the more likely other people are going to put bids on that level, how it's going to be incorporated into algorithms and robotic trading, and it becomes this self-fulfilling thing. And I also really want to drive home that brief moment where the price hits that support and resistance level, that is the moment of true equilibrium. It's when the price has reached its perfect zenith, it stops and starts to turn in the other direction. And just for a brief moment, you find that true price action equilibrium, and it's absolutely wonderful. I also really hope that you understand how you can use support and resistance levels and employ them on some basic trading strategies. We've only pointed out 2 of them. There are many, many available to you, but those 2 strategies can be very effective, and I hope it was an excellent introduction on how you can use support and resistance levels for your own trading.